Was ist noch besser als ein guter Plan? Die Möglichkeit, ihn zu ändern. Mit integrierter KI bietet Workday kontinuierliche Innovationen, die Ihnen helfen, agil zu bleiben, egal was passiert. Workday, the finance and HR system for a changing world.
This is BTO, Beyond the Obvious 2.0, the economics podcast with Dr. Daniel Stelter.
Hello and a warm welcome to my podcast. My name is Daniel Stelter. I'm hosting a weekly podcast on economic issues in Germany called BTO, Beyond the Obvious 2.0. From time to time, I have the pleasure of inviting English-speaking discussion partners. For the German audience, I'm doing a translation and summary of the conversation. But I thought it would be worthwhile to publish the interview in original as well. Therefore, whenever I have an English-speaking discussion partner like today, as a bonus track to my podcast, there is the original interview.
Tim Congdon is an economist and businessman who has for over 40 years argued in the UK policy debate that banking and money can have powerful influences on macroeconomic outcomes. He is currently chairman of the Institute of International Monetary Research, which he founded in 2014. The institute is based at the University of Buckingham, where he is a professor of economics. His most influential position was a member of the Treasury Panel of Independent Forecasters, the so-called wise persons, between 1992 and 1997, which advised the Chancellor of the Exchequer on economic policy in a successful period for the UK economy.
Dear Professor Congdon, a warm welcome to my podcast.
Thank you for inviting me to take part.
Professor Congdon, you've been, as a young economist already, very influential in the UK, as I've read in the newspapers, as you were advising in the 1980s, the government, and you were a big fan and a big supporter of monetarism. Probably you could start by telling my audience how the time felt and what you've done at the time being, and what also might be the learnings from 40 years ago to today's time.
Well, as a young man, I was very lucky to be asked to work on the Times as an economic journalist. And it was a fascinating time. It was continuous economic crisis as far as Britain was concerned, rapid inflation. And I became persuaded that the answer to rapid inflation was to reduce the rate of growth of the quantity of money. And so, if you like it, this became my mission. I wrote newspaper articles, I wrote academic papers, I wrote books arguing for monetarism, controlling the quantity of money to reduce inflation. This became government policy in Britain in the late 70s and early 80s. We did get inflation down, but there's a lot of controversy. And the system I favored was then kind of watered down from the mid-1980s. I was an advisor on something called the Treasury Panel, the so-called wise persons, in the 1990s. Can I just say that macroeconomic policy in Britain became very successful? We did reduce inflation and stabilized it. We did have a period of 15 years of steady economic growth. And in my view, this was largely because of the adoption of monetarist policies. For debate and discussion, but that's my view. We then had the Great Recession in 2008, 2009. And people have forgotten the basis of the reduction of inflation that was achieved in the 1980s and 1990s. And what we have today is a kind of total flouting of the rules of sound monetary and financial management with large budget deficits, and certainly in the American case, extraordinarily high monetary growth. And so I've been warning about inflation through my emails and through my institute, through my newspaper articles and so on, for the last year to 15 months. So in a about 3 minutes, I've kind of summarized my career. I hope that's clear. And
that was a very good start. And let me go back, because you said, well, we had the successful economic policy. It was not only the case in the UK, it was also the case, I think, globally. But some people might argue, well, it was a period in which we had a big move in globalization. We had China entering the global market. We had Eastern Europe entering the global market. And this was kind of a deflationary shock, because hundreds of millions of people were joining the labor force. And this was a true cause for low inflation, because on the other hand, we've seen that central banks were kind of very active in intervening in financial markets when it was necessary, supporting speculation in a certain sense. So is it really just monetary policy, or was it just because of the impact of globalization?
Okay, on globalization idea, the ratio of trade to world output has been rising since the late 1940s. I think that's a very good thing, and that is a result, obviously, of the liberalization of trade and finance in the decades following the Second World War. If you look at the chart of the ratio of trade to world output, it was rising very sharply. In fact, it was rising most sharply in the 1960s and 1970s, when inflation was taking off. Globalization didn't stop inflation then. And globalization is a force for the good, but it can't stop inflation. Let's just be clear. Britain does nowadays have large imports from China that it didn't have in the 1970s. Those imports would only be, say, 5% of GDP. So the reduction in the price level from having goods from China rather than goods, say, from Japan is going to be some fraction of 5% each year. Sorry, this doesn't explain inflation. No way. Inflation is explained by the rate of growth of the quantity of money relative to the rate of growth of the quantity of goods and services.
But let me just, let me push back here just for the purpose of clarifying, also for the audience. Some people would say, well, but there was pressure on wages. So in the 70s, people could still ask for higher wages. Once Eastern Europe opened, so I'm from Germany, you're from the UK, and I remember that many people from Eastern Europe came to the UK for working, and I would assume this has increased pressure on wages. This has put pressure on wages in the UK. And even you say, okay, we don't import so much from China, but if companies can threaten their workforce by moving production to China, if they don't accept lower wage increases, doesn't this also play a role?
No, it's a matter of quantities. What I fully accept is that the opening of the world economy does benefit the trend rate of growth of output. So when I put that proposition, the rate of inflation depends ultimately on the rate of growth of money relative to the rate of growth of output. There are some complications there, but that's the guts of it. Then it is perfectly true that globalization boosts the rate of growth of output a little bit. One's talking numbers like quarter, half, maybe at the outside 1% a year. The truth is that globalization was most intense for the world economy as a whole in the 1970s and 1980s, not in the last 20 years when China's become so important. 1970s, 1980s, we also had rapid inflation. We had rapid inflation because of rapid monetary growth. And may I just say here, just so obviously I know the audience is mostly going to be German. In Germany, you set as an example in the 1970s and 1980s, you had the Bundesbank. The Bundesbank did believe in monetarism. The Bundesbank held back monetary growth. But Germany had a much lower inflation in the 1970s than Britain did. That was because monetary growth was controlled. Both Britain and Germany were open to global influences, including the freeing of trade and competition from imports.
Let me probably go into and just split our discussion in two phases. So let's take the 1980s until the financial crisis. And in this period, in the Western world, debt levels have grown significantly. We all know that the private debts went up significantly by private households, by corporations, or the government debt went up in absolute terms, but also relative to GDP. And I would say, well, debt is nothing else than also money, because as we know, the private banks create most of the money we are using. So we have seen a fast growth in debt, but we haven't seen higher rates of inflation. We have seen asset prices rising. So would you say, well, increasing debt levels is a sign of monetary inflation? Or would you say, well, that's not money, it's something else?
Okay, debts are of various kinds. There's obviously the banks owe us our deposits. So the banks are in debt to us because they owe us our deposits. They've got their loans, of course, on the other side of the balance sheet. As a matter of fact, the size of bank balance sheets relative to GDP it changes, but doesn't change all that much over the decades. And so the growth of debt that you're worrying about here is partly, really, it's only in the last really kind of 10 or 15 years, there was a reduction in debts until the Great Recession. The debt is public debt. To some degree, there's private debt that's outside the banking system. I'm not that worried about debt at the moment. It's partly because the interest costs on the debt are so low, so the debt's easy to service. But let's just be clear that most people run into debt not to finance consumption, but to buy a house or some other asset. That's very normal. That's obviously a small business person may borrow from the bank or borrow it from elsewhere in order to invest in a business. And there may be some debt because of that, but there's an asset being created by that process. Similarly for companies, they don't borrow in order just to splurge, they borrow in order to acquire capital assets. And so if you look, I've done this exercise for the United States, I'm sure it's possible to do it for other countries too. You look at, say, the last 50, 60, 70 years, you'll find that the ratio of debt, private debt to national income is much higher than before, but the ratio of wealth, of assets to national income has also increased, and net wealth to national income has actually risen. Net wealth being the value of all those assets being created minus the debt, and then you compare that with the national with output and income. On that basis, I think people are sensible, rational, forward-looking, and so on. We shouldn't get hysterical about debt. The world cannot be in debt to Mars or Jupiter.
Okay, but of course we also know that higher debt levels increase or can increase the fragility of financial systems, as we've seen with the financial crisis. So basically, I summarize, you say, well, we have this period where we've been very successful in monetary policy. We didn't have inflation. We had rising debt levels, but they are not such an issue because asset prices went up as well. And then we had the financial crisis. And after the financial crisis, many people, I don't know about you, but many people said, okay, now given the direction of the central banks, we will see inflation coming back. So, but obviously this was not the case. It was not the case in the US. It was not the case in Europe because broader money aggregates didn't grow as much. The central banks were active, but banks were not providing so much new credit. And therefore people would say, well, there was no credit growth. Therefore was no additional demand and no inflation. So why do you now alert your readers in the last 18 months? Why do you alert them now to the risk of return of inflation?
Okay, well, you remember that just after the Great Recession, we had this move towards quantitative easing in a number of countries, asset purchases by central banks. And this is widely characterized as printing money. Well, it's certainly true that if the central bank or the government purchases assets from you, me, the non-bank private sector, that increases our bank deposits, and that's money. But it's important to realize that in the years just after the Great Recession, this was kind of 2009, 2010, 2011, the banks were being bullied by regulators. They're being forced to reduce their loans to the private sector. And that process was causing the quantity of money to shrink. When I repay a bank loan, I use my money in my bank deposit to repay the loan. The deposit disappears from the economy, so does the loan. So the process of quantitative easing simply offset this contraction of money. And as you say, the quantity of money taken as a whole, broadly defined, grew very slowly in the early 2010s, just after the Great Recession. So all those forecasts of inflation because of money printing were a mistake. And can I just say, somewhat to sort of pat myself on the back, I didn't make those forecasts. In fact, I made very clear that in my view, the low money growth would lead to low inflation, despite the so-called money printing of QE. Okay, that's what happened then, roughly 10 years ago. What's happening today? What's happening today is that the banks are not under any special pressure to reduce their lending to the private sector. The central banks are buying assets, and the quantity of money broadly defined, because what I always look at, is rising rapidly. Now, again, it varies between countries. So that the United States, in 2020, they had a quite extraordinary period in really, there was the 4 or 5 months up to June 2020, when there was such rapid monetary expansion that the increase in money in the year to June 2020 was the highest since 1943. It was 26%. It was the highest in American peacetime history. And that therefore is an utterly different situation today from that 10 years ago.
Yeah, and we want to go deeper on this, because that's why I thought I'd give you a call and I want to discuss with you, because as far as I know, the formula is quantity of money times velocity is price level and output somehow. That's that's right. And as far as I know, the velocity of money has been coming down since the year 2000. I think in the US in the year 2000, it was the highest level of velocity. And since then, it has dropped constantly. And it has continued to drop. Now, even last year, you pointed out that the velocity, that the quantity of money has been going up significantly, but the velocity has come down. So, therefore, do you expect velocity to come back?
Let me I'm going to bring in the oracle. I'm going to bring in Milton Friedman. In 1959, he gave some lectures, the Miller Lectures in New York. And what he said there, this is about broad money. By the way, broad money was generally the concept of money that he favored.
Broad money is the broadest measure, encompassing narrow money such as cash and checkable deposits, along with less liquid assets such as certificates of deposit, foreign currencies, money market accounts, marketable securities, treasury bills, and anything else that can be easily converted into cash, but not including company shares.
Broad money, he expected it to rise by about 1% a year more than nominal GDP in the United States. Do you know what's actually happened since 1959 to broad money in the United States? Well, I'll give you the figures. The figures are that broad money has risen on average by 7.3% a year and nominal GDP by 6.4% a year. Well, that's quite some forecast, eh? That's 60 years ago, and that's what's happened. Friedman was right. This idea that velocity goes all over the place, unpredictable. Basically, Friedman was right. Of course, last year you had a contraction in spending because of COVID. In the United States, you had some reduction in output. So nominal GDP fell. And you had this fantastic growth of money. So, of course, the velocity of circulation went down. But the heart of my worries about inflation in the United States are that, first of all, modern medicine has achieved the miracle of vaccination. We're going to return to medical normality in the next year to 2 years. And there's all this money that's still around. And there's this money, if the velocity of circulation returns to its long-run trend, given by this 1% figure that Friedman forecast back in 1959, which was correct, then we are heading for a big jump in velocity. When there's all this money still around, we are heading for major inflation. Can I just say before I finish that the increases in house prices in America and the increases in share prices fit in with this story beautifully. Essentially, asset prices typically in most business cycles precede what happens to the prices of goods and services in the economy as a whole.
Oh, but we have, if you say so, because, we have the asset prices, I think we would agree, are already rising for a longer period of time, much faster than the economy. So I just saw a chart in Bloomberg where they showed that I think in the past 10 years, the prices of stocks in the US rose by 70% faster than the profits. So it's not just last year. So you would say the period of rising asset prices as of the past years is a signal for upcoming future consumer price inflation.
That's right. Obviously, there are, you're quite right, but there has been, if you like, some upward revaluation of assets relative to incomes in the last 10, 20 years. This may be due partly to the very low interest rates currently being seen around the world. However, let's just not forget that in March, April last year, there'd just been a stock market crash. I remember from my friends in the real estate world, in April, May, June last year, they're being very worried about the collapse in the values of offices, warehouses, and so on. So it comes and goes a bit. But obviously there has been in the last year an increase in share prices, an increase in house prices. I'm talking particularly about the United States, but not just the United States. That's out of all proportion to what you see in a normal year.
So, but okay, now we have pent-up demand, or we have demand which could not be realized due to Corona. We have much higher cash positions of corporates and mainly private households. And then we get this demand spike. The velocity goes up, we get more demand, supply cannot follow, as we cannot currently already see with limber. So there's a spike in inflation, but it's just a spike. So in 2023, we are back to normal then?
Well, this is in a way one of the crunch questions that one has to deal with. And one of the points I emphasize here is that to get back to 2% inflation, we need to, government central banks need to reduce the rate of growth of money to under 5% a year. You might wonder, why are you so confident about this? But let me just say that in the 2010s, in some sense, we had an amazingly stable period because we had a long series of years in the Eurozone, USA, and the UK of inflation about 1 or 2% a year. What I would expect to be associated with that is money growth of around about 3, 4, 5% a year. And, that's exactly what we had. If you like, the central banks did finally learn the lesson that Friedman gave back in 1959. Friedman recommended in those lectures that money growth should be brought down in the United States to about 4% a year, in line with its long-run growth rate of output if people want to get inflation down to very low figures. The central banks amazingly did this. They didn't mean to, but that's what they did. There was low inflation. Now we've had this explosion in money growth in the USA up to 26% at its peak. At the moment, it's around about 12, 13% on an annual basis. In the Eurozone and the UK, it's around about 10%. We have to get back to under 5%. That's a challenge because while there are these large budget deficits out there, the central banks and banking systems will be asked to finance the budget deficits. That will create excessive monetary growth. And may I just say here, I'm just saying the same kind of thing I said as a young man in the 1970s. You cannot reconcile large budget deficits with low inflation.
Before we come to the scenarios, in the past 10 years, we always heard from the central banks, inflation is too low. So they always said, we do quantitative easing because we aim for an inflation rate of 2% or above. And they failed. So obviously, at least I could have the impression that it's easier to bring inflation down than to generate inflation. It looks like. Then the Fed said now, when inflation goes above 2%, we don't do anything about it because we had so many years with undershooting, so we have to make up for this. So first of all, what's your view on them failing in the past? And the question really is, is there an appetite by central banks to fight inflation at all?
Okay, well, can I just say that in Britain, the inflation target set back in 2003, in fact, was for 2% consumer price inflation. And in fact, the Bank of England has achieved that. It's actually on average since then been 2.1%. There have been some periods of under 1%, some periods over 3%, but on average it's been met. It may be that in the Eurozone, the United States, some people are worried that inflation was kind of 1 or 1.5% rather than 2%. I think that's extraordinary. Relative to where we were in the 1970s, 1980s, these are amazingly low, stable, fantastic numbers. And may I just cite here, for example, Ottmar Issing, who was chief economist, Bundesbank, chief economist at the European Central Bank, a figure I much admire, very active in German public life. He has said, what's wrong with 1% inflation? Quite right, too. 1% inflation is fine. So I don't really know why, for example, Jay Powell at the Federal Reserve at the moment is so exercised about a period of years when inflation in America has been 1.5% rather than 2%. they're going to get a real shock when they suddenly, because I'm afraid, in my view, the Federal Reserve they don't know what they're doing at the moment. They're in a terrible intellectual mess. And when they see month after month these numbers of 0.6%, 0.7%, this is the annual figure moving up towards 5, 10%, they're in for one hell of a shock. They have broken the cardinal rules of monetary management by the way they've mismanaged money in the last year, 15 months.
Okay, but
there's an awful lot more to say, but I think that probably gives you something to come back on.
I continue on your path. You say we had too much money creation. We have had too big government deficits, which were basically funded by the central banks. Now we will see an increase in demand, and this demand is going to drive prices up. We have a return on inflation. The problem clearly is, you pointed out in the beginning, you don't see debt as a problem, but I would say probably it's a problem because the debt levels and the asset values can only be sustained if interest rates remain low. But how do you fight inflation as a central bank if you don't increase interest rates?
Okay, well, there's going to be a problem coming out anyway. Let's just be clear. We have had in the last, last year, since the stock market and housing market troughed, in March, April 2020. We had a fantastic year on the stock market. There has to be, I'm afraid, a bear market out there. I think the way that I put this in terms of underlying monetary theory, I hope I don't sort of puzzle people by what I'm about to say. You can have, in the long run, nations can't make themselves rich by printing money. That's obvious. In the long run, the growth of real money balances has got to be similar. Inflation-adjusted money balances must be similar to the growth of real output. We need money to deal with our transactions in real things, goods and services and assets in the long run. Then inflation just kind of washes out. If you have a period like the one I've just been through, and there's been a huge growth of real money, inflation way beneath the rate of growth of money, there'll be an offsetting period out there when money balances contract relative to inflation, the price level, and there's a squeeze, and then the asset prices will fall. The problem for policymakers is that, that's going to, it might be coming up anyway. It might be precipitated to some extent by higher interest rates. Alternatively, it might be due to a cut in budget deficits. What I think we need to be clear about is the long-run rules for achieving financial stability, and they are balanced budgets and low and stable growth, the quantity of money.
But Tim, I would not point and say, but listening to you, and I paraphrase this now, sounds like me like a bit you're falling out of the actual times, because today I think politicians don't think about cutting back. They say it's time for the government to be back in. We want to have more active governments. We want to fight climate change. We want to fight inequality. We have to invest in infrastructure. And then we have people...
We'll do it all in printed money.
Yes.
There's going to be inflation.
Yes. And
there's going to be inflation.
Yes.
I mean, anybody sort of rational and objective, with sort of been through a few decades, this kind of thing, looks at what the public debate at the moment, you look at, the G7 summit we've just had. It may sound very hard talking about these leaders of the leading industrial countries. To me, they weren't living in the real world. They were talking as if there were no resource constraints on their spending. Of course there are.
But if you look in the US and also partially already in Europe, we have the so-called modern monetary theory, MMT, I discussed in my podcast before. And the proponents say we don't have scarcity of money. We can fund as much as we like. And the only risk is inflation. They would agree with you. But then it's very simple. We just increase taxes and then there's no inflation.
Well, ultimately, we can only consume what we produce. Simple as that. And it's a fantasy to imagine that by going to the printing press, we can make ourselves rich and consume more than we produce. So it's really a matter of talking about the mechanisms by which you go to the printing press, you go to banks, you ask them to create new money. There has to be some balance between the amount of money created and the growth of goods and services. The key principle of monetarism is that the growth of money should be the same as the trend growth rate of real output of goods and services. Not very complicated. It's just saying, if you like, not just the laws of economics, the laws of physics. We cannot consume that which we do not produce.
Martin Wolf in the FT, he has written a comment recently about inflation, and Well, his summary was, in short words, was, well, Milton Friedman, that it's a monetary phenomenon is not really true. It's always a political phenomenon. So would you agree that basically if you now are going to see a return of inflation, it's basically because our politicians decide they want it because they don't want to save, they don't balance their budgets, and they want to rely on the central banks to fund their investment programs?
I'm afraid Martin Wolf is talking dangerous nonsense. Both he and I lived through the 1960s and 70s in Britain. And I'd like to remind Martin, in fact, they did write a letter to the FT about his comment, but they didn't print it, that we had this idea that you can control inflation by having agreement between the employers and the trade unions, and you have government-imposed controls on prices and wages, sometimes backed up by statute, sometimes not, sometimes more voluntary. Didn't work. And the Conservative government of 1970 to 74 fell on exactly this problem. It tried to control inflation by pricing house policies, by politics, if you wish, and in the end, it didn't work. And that was the background to Thatcher's becoming leader of the Conservative Party, monetarism, the advocacy of reduced monetary growth to defeat inflation, all these things. To me, what Martin said there, that inflation is a political phenomenon, was very dangerous and very wrong.
Let's go again back to the scenario. We have a return of inflation rates go up. And normally the central banks would have to increase interest rates. And I spoke about the Fed, but I would say the same about the ECB. And you said, well, we have to accept the stock markets we had a bull market, we might get a bear market that we have to accept. But it's difficult to accept this, I think, for politicians and also for central bankers, because they say, our whole financial system depends also on these high asset values because many loans, many credits are going to turn sour if interest rates go up. So would you see the risk that they are going to let inflation run and just hope it's going to end on its own?
I'm afraid so. I think we had great moderation, period of moderate, stable macroeconomic outcomes, largely, in my view, because of the change in macroeconomic thinking that was due to monetarism. There was then the Great Recession, which was not, in my view, due to capitalism. It was due to a mistaken tightening of regulation on the banking system, which caused the banks to shrink their lending to the private sector. That then had to be offset by this QE, this large-scale money creation by the state. And this then seems to have misled, to have deceived many people into thinking that governments can just spend money freely and that central banks can finance budget deficits without limit. And that's what seems to be the current belief of far too many governments and politicians. We are heading for trouble. And in my view, the obvious symptom of that in the next 2 or 3 years is going to be rising inflation.
But, as you've experienced the 70s and 80s, as you pointed out, my recollection is that the inflation started at the end of the 60s. First it was, I think, due to the Vietnam War, then it was the oil price shock. But it took some time until the public was unhappy with inflation. As I remember, because with Thatcher and with Reagan and with Volcker, this was actually after 10, 15 years of higher rates of inflation. So would you expect us to have a similar long period, or would you say no, also probably giving a more older society, depending more on savings, that there will be an earlier pushback?
Well, can I just say, I think that in the Eurozone and the UK, and also, by the way, in Australia and Japan, there isn't going to be the same kind of inflation problem as the United States. It's the United States which is the outlier at present in really breaking all the rules. In my view, we're going to see serious inflation in the United States, meaning inflation between, say, 5 and 10%, and seeing that really quite soon, like in the next, really late 21 and on into 2022. That's quite a brave forecast, but that's what I believe on the basis of the excessive money growth that we've had. How will the different nations react? You say that in the past there was not much concern about inflation in the 1950s and early 60s. I don't know. All I would say is that I think there was a chap at the IMF many years ago who said this, that inflation is a little bit of pregnancy, tends to grow. And the idea that societies benefit from having an inflation rate of 3% rather than 1% is just rubbish. They don't. And can I just say here, before I finish this question, Germany and Switzerland really provided an example to the rest of the world by keeping inflation down in the 1960s, 70s, and 80s. And what they showed in those decades was that it is possible to manage a currency not backed by gold and to have a sound currency. We should learn from what Germany and Switzerland did in that period.
Chris Watling of Longview Economics, I don't know if you know him. He was a guest in my podcast a few weeks back, and because he wrote a piece in the FT where he asked for a restart or reset actually of the global monetary system. And in the podcast, he said, the Bretton Woods system, or the end of the Bretton Woods system is now nearly 50 years ago. And normally monetary systems don't survive so long. So it's time for reform. And he was more worried than you about the debt levels. Would you agree with him that, we need a new monetary order? Or do you say actually everything is fine? We just need to get back to pre-2020 before, to the time before we had these huge deficits and the huge central bank intervention leading to the huge increase in the monetary base?
Well, the Bretton Woods system from 1945 to 71 was a fixed exchange rates so that the nations kept a fixed link with the US dollar, and the US dollar itself was linked to gold. So in a sense, the world was still on a kind of gold standard. And it's really been the last 50 years you've had to learn how to run a currency without backing of gold or precious metal. And if you like, this is a real challenge for mankind because, for centuries we'd always relied upon a precious metal as a basis for our monetary system. The truth is we're still learning. I mean, the point about monetarism was to replace the gold standard with a managed currency using that principle that the quantity of money should rise at about the same rate as the trend rate of growth of goods and services. And, that's the really crucial idea. Do we need a new international monetary system, a new Bretton Woods? I don't think so. As long as governments and central banks are respecting that key principle of limiting monetary growth, the trend growth rate of real output then we'll be okay. And can I just finish on this by saying that there are periods in different countries, both you look at comparisons over space, some countries have had rapid money growth, some had slow money growth. Those with rapid money growth had rapid inflation. Those who had slow money growth, like Japan, have had hardly any inflation. Look at then different periods in the same country. Those periods of rapid money growth, you get rapid inflation. Those periods of low money growth, you get low inflation. The theory works. The problem, I'm afraid, is to some extent it's the media, and I'm afraid, frankly, Martin Wolf on the Financial Times is a good example of people not respecting what is simply the truth. And the media, and I'm afraid also the politicians fantasizing about what they can do. You cannot consume that which you do not produce. It's not very complicated, really.
Well, politicians would say, well, we have not enough in demand. They would say we have, underutilized capacity. We have a so-called output gap, and that's the official explanation to start embarking on government spending programs. So I can, I follow you with your criticism, but people would say, well, Milton Friedman's formula has not hold out because velocity has dropped. You say, well, it has hold out, as you see, demonstrate with your long-term data. So we run in a scenario where we will see higher inflation. And of course, this leads me to the question of, what this actually means. But before we come to this, I would like to ask you one thing about sovereign money. You know that sovereign money is a theory where you basically say, okay, all money we utilize is only created by the central bank. So would a monetarist support the idea of sovereign money so that private banks cannot anymore create money?
This is an argument about freedom, really. Do we want to ban banking? Now, just to illustrate this, there are societies that have banned banking. There are societies that have banned the payment of interest and so on. It's actually part of some religions, including, Islam. It's extreme Islam. They don't have this. And banking is also, of course, some types of Christianity, medieval Christianity. They wanted to stop banking. No, I'm in favor of freedom. And all that a bank does is accepts deposits from the public and companies and so on of cash. And it repays those deposits with cash. And it does so pretty regularly, I think. Don't you agree? So why should we stop the banks doing this? If you wanted to go back to a world of either any kind of money we can use, is that printed by the state, or a precious metal, then we reverse a huge amount of economic progress. No, I'm not in favor of stopping the creation of money by banks, by privately owned banks, not at all. And this is one of these things that societies that try and stop banking or insurance or gambling, these are societies, I'm afraid, that tend not to be societies we much admire.
So my audience is going to say, well, why didn't you ask a question? I have to ask you a question because before we actually started recording, you also pointed out that you had a career in investment business before, in the investment industry. If you now have the scenario of much higher inflation rates in the US of 5 to 10%, as I said, we will have higher inflation in the Eurozone as well. And I would say we need it also. Probably the Europeans would say we need it. What should people do to prepare themselves? For example, the Germans have they are very big savers. They save a lot, but they put their money on the bank account or in life insurance or whatever. But they don't have much real estate. They don't have much stocks. So, what is your view? What do you say? Well, in such a scenario, the US dollar has to drop in the coming years because they got higher inflation rates. Or what would be your scenario in this regard?
Well, this is a difficult one, and obviously I'm an investor myself, and I have to think about these things. And most of my investments are in companies I believe in, which is the most important thing. Nothing that. And then obviously at the moment, holding bank deposits, holding bonds is not a good idea, and I really am worried about all those savings policies that depend upon the value of bonds, because bonds are just completely mispriced. If I'm right about inflation, I'm pretty sure I am going to be right about inflation. So bonds on yields of 1.5% is absurd. I suppose that, and obviously in Germany, the households, some of them, their memories of what happened in 1923, and it was, I would say, invest in companies you believe in the stock market, and also have some assets in houses and other kinds of real estate. They're relatively safe.
I think it's a fascinating discussion because, Tim, and I thank you very much for your views here, because look, whenever I read newspapers and also in Economist and Financial Times and not only the Economist, but also economists who work as a profession, they always point out, okay, it's only transitory, we won't see a return. And, we had the big savings glut, and we got China, and we got aging societies. And there's so many arguments in favor of not having a return of inflation. And so you're basically one of the few who now say, well, we have this fundamental trend change now coming. And this makes it a very fascinating view.
I hope I'm wrong, but I don't think I will be. And it's, I look at money growth every month. I look at monthly figures from the United States, China, Eurozone, UK, Japan, and the United Kingdom. And, we had a very benign, peaceful period in the late 2010s. It's all been shattered in the last year, 15 months. Like there's the great stabilization has given way to the great destabilization.
And this destabilization is going to have be impactful because rising interest rates, and be it only a little bit, are going to cause trouble for debt markets and for asset markets, I'm pretty sure. So let's assume Mr. Powell and Mrs. Lagarde were now listening to our conversation, to the podcast, and they would say, okay, now we are convinced. We see, it's been correct what Tim has said, and we have to change it. Can they still change it, or did it already pass the point of no return?
In the long run, the growth of nominal GDP will be similar to the growth of money. There's been so much excess money created in the United States that they have got an adjustment problem of some size, almost whatever happens from here. Money growth needs to be reduced back to under 5% a year, which, as I said, is going to be difficult while the budget deficit's so large. I think the problems in the Eurozone, in one sense, are much simpler because they didn't reach the same kind of levels of monetary excess as in the United States. And of course, there isn't a Eurozone federal budget that can have a deficit like that in the United States. There are deficits at national levels, of course. The problem in the Eurozone is rather different. It's really the tensions between Italy and Germany and so on. I'm relatively relaxed about a return to normality meaning sub 5% money growth, inflation back down to 2 or 3%. I'm relatively relaxed about the Eurozone and the UK. Japan, I'm not worried about at all. China actually didn't really have a monetary splurge at all in this period. It's very much the United States I'm worried about. And there, I'm afraid there's an adjustment problem.
Professor Congdon, thank you very much for your time. I think it was a fascinating review of the past 50 years and an outlook. And we are going to see what's happening. And probably in the future, I might call you again and we might have a review after 2 years, what you said and what we've learned out of it and how it's going to go forward, if you agree.
I'll look forward to that. That'll be fun.
Thank you very much.
I hope you enjoyed the conversation with Tim Congdon. I hope I can welcome you back again for another episode of my show. This was Daniel Stelter.
BTO, Beyond the Obvious 2.0.
Finance leaders, do your arms hurt? It's hard getting pulled in 2 different directions every day. Somehow you're supposed to cut costs and drive growth. Not easy, but it can be if you use Brex. Brex is the only corporate card and AI-powered spend platform that lets you control spend before it happens. Brex also automates busy work and gives you real-time visibility, so you have more time for strategic work. Ready to save and grow? Get Brex, the platform that helps you make every dollar count. Visit brex.com/grow.